9:30, so I shall start this webinar. Good morning to you all. Today's webinar is entitled, excuse me, Share Schemes for Private Companies. Probably last about half an hour, and you can ask questions afterwards, either using your control panel, or you can just email me afterwards if you want to do that, or give me a call. My name is Sarah Anderson. I'm a share scheme solicitor. I've worked in share schemes for probably about 20 years, mainly focusing on private company share schemes. My contact details are there below if you need them. Actually, the 0208 number is not terribly operational at the moment because we're all working from home. I expect like quite a lot of you. But if you want to drop me an email, I'll get back to you as soon as I can. So the topics today in this webinar, it's supposed to be a sort of fairly practical introduction, not particularly technical. So I'm going to be talking about why you'd want to introduce a share scheme in the first place and some design considerations you might want to take into account when you're starting out. I'll give a brief summary of the main schemes that are available to private companies and then run through some real life scenarios we've seen in our client work. So to begin with, if you're a TED Talk aficionado, you've probably come across Simon Sinek. I'm blatantly copying his theory of start with why to begin this presentation. The outline argument is you always start with why you want to do something before you move on to how you do it, and then last of all, what are you actually going to do? And that does work quite well for designing and implementing share plans, as well as a lot of other things in life. So if we're looking at share schemes, my little world of share plans, you can usually break it down as follows. So the first question is, why do you want to put in place a share plan? And typically that's to get engaged, incentivized employees, but there is often more to it than that, which I'll come to. Then you talk about how we're going to do it. So the answer is you establish a share plan that's going to deliver the appropriate rewards to your employees. And last of all is the what, which is what share plan you're going to use. And there's a whole range of acronyms around the edge there, which is the kind of share scams you might want to think about. We're often contacted by prospective clients who already have, or they think they have, the what, which is the type of share scheme. And that's often because they've worked somewhere previously and benefited from a particular type of scheme, or they've heard about particular tax advantages that might attach to a scheme. And very often they've got the what part absolutely right, and we can just crack on with that. But sometimes it's not necessarily the right scheme, and that's usually because they haven't looked at the why part first. So the why question is going back to the engaged, incentivized employees. But to be fair, who wouldn't want that? We'd all like engaged, incentivized employees. Sometimes there's a bit more to it, and you might want to ask a few more questions. So why do you want them so particularly engaged? What do you want them working towards? Are there any particular objectives? Are you looking to sell your company? Are you just looking to increase growth or profitability? Is that for one particular division? Is it for the company as a whole? Are you maybe looking to retire? What employees are you looking at? Are you looking at the key employees or everybody, or at different levels? And you also need to remember that that why doesn't just involve your employees. You obviously need to take into account the other interests. So for example, the shareholders. You need to make sure in particular that your existing shareholders are happy to give away some of their equity and they don't feel like they're giving away too much to employees. Are they happy that the growth of the company is going to be worth the dilution they might suffer? You need to really make sure their interests are aligned. The interests of the employees and the existing shareholders are all lined up. And of course, the company needs to benefit from any plan you put in place, and your corporate objectives therefore should really form the main focus of any plan that you're going to operate. So for example, your employees probably shouldn't really be realizing reward until you've achieved some kind of performance target or corporate target, which might be increased growth or a particular target in a unit, or even the sale of the company as a whole. So those are some of the whys you might want to think about. And when you've got through your why questions, then you can move on to the how stage, which is really down to the design considerations and how you're going to meet the objectives you want to achieve. So for example, what's your ultimate goal, or the goal of the other shareholders? Are you looking to sell? When are you looking to sell? Who are you going to sell to? Are you looking at this as part of your succession planning, or maybe you're entering into a series of entrepreneurial ventures. You're going to be moving on and acquiring new companies and selling them again in the future. Maybe you're not looking at a wholesale. Maybe it's just one key shareholder looking to exit. Maybe you're going to be looking at a partial sale to an investor. Maybe you're looking at joint ventures or mergers. You need to think about how your share plan is going to get you to that point. And indeed, whether having employee shareholders is going to impact on your ability to achieve your major corporate objectives. And then when you look at the plan, how's that going to look? Is it going to be for everybody, or is it just for a selected few? When do you want people to actually have share rights? Do you want them to acquire share rights, vote, dividends, and so on straight away, or not for a few years, or not until they've hit performance targets? Really, are you looking backwards and forwards? Are you wanting to reward people who've been loyal to you in the past and performed well, or is the reward dependent entirely on future performance of your employees? So that's one of the questions there, is really, are you looking at shares or options? So the share obviously gives some employees the rights attaching to a share, which might include votes or dividends, depending on the share class you use. Whereas an option is just a promise to acquire shares in the future, but at a price fixed today. So you decide when you set up the plan when the time is right for employees to become actual shareholders. Maybe after 3 years to test loyalty, maybe when the company's doubled in value to test performance, or maybe only when the company is actually sold, if that's your overriding objective. A couple of other things you might want to think about is timescale of when you're going to put the scheme in place. Very importantly, what's the percentage of shares you're going to use? So that's the dilation question for shareholders. They might be happy to give away 5 or 10% of the company, but if you go above that 10% number, people sometimes can get a little bit antsy about how much value they're giving away. You'll also need to think about leavers. What's going to happen if your employees leave? You want to make sure really that if you've given shares to employees, you haven't got a bunch of ex-employees holding shares in your company afterwards. Not great from an administrative point of view, and really doesn't meet the requirement in terms of an employee share scheme being there to motivate and retain employees. You're there for employees, not for ex-employees. How long do you think the scheme's going to last? Which might lead into how often are you going to make an offer under the plan? Is it going to be a one-off thing, or are you going to be making regular annual awards? And of course, one impact of making regular annual awards or more frequently is the cost consideration, because every time you make an award, there is going to be some time and cost involved in that. So those are just a few things you need to think about for the how. Whenever we talk to our clients, obviously we go through all those questions and work out what the right answers for them are, and then you can design your plan based on that. And at that point, you're then in a much better position to look at the what's, which is what type of share scheme you're going to use as a private company. And in some cases, just one will do, depending on what you want to do. But sometimes you might want to look at a mix of schemes. So, for example, some of the tax advantage share schemes can't be used for non-employees, and you may want to use a mix of shares or options in your share scheme. So what I've done here is I've divided up the schemes that we commonly use into different boxes with 3 subsectors. So there's plans where you can grant options over shares, which is the EMI, CSOP, unapproved, and Phantom. Schemes where you can let employees buy shares, and plans where you gift shares to employees, i.e. without them paying anything for the shares that they acquire. So just running through those alternatives. Obviously, enterprise management incentive is the scheme we put in place most often. Just as a reminder, the option is a promise to the employees that they can buy shares in the future at a price fixed today. It doesn't give them any shareholder rights until they've exercised their options, and the price at which they buy shares and the timing is usually fixed at the outset, so there's quite a lot of flexibility there. And EMI is particularly flexible and particularly tax efficient. You can grant your option over different classes of shares. You can attach any performance conditions you want, ranging from really simple exit only option exercise, where they only sell if only exercise if the company is sold, to more complex time-based or performance vesting. You can choose the exercise price at which the options are granted. if you set the exercise price at less than the market value of the shares at the date of grant, there is a tax charge on exercise, but otherwise there shouldn't be any income tax or national insurance contributions when the options are exercised. And once the shares are sold, all gains are subject to capital gains tax rather than income tax and national insurance contributions. And at the moment, EMI option holders benefit from business asset disposal relief, previously known as entrepreneurs relief, which should give them an effective tax rate of only 10%, even if they own less than 5% of the company shares, which is the usual rule for that relief to apply. Probably a caveat here is I have absolutely no idea what the Chancellor is going to be doing with regards to capital gains tax, or indeed any other tax in the next few years. So I don't know how long that relief will last. At the moment, however, it's still in place. So I would be inclined to make use of EMI now while you still can, in case it disappears in some way, or at least that entrepreneurs relief benefit disappears. Anyway, it's very flexible, very tax efficient, so you can see why we will always recommend EMI to companies that qualify for it, which is broadly smaller independent companies with fewer than 250 employees. If you can't use EMI, we will sometimes recommend the company share option plan, also known as CSOP. It's the next most tax efficient option plan available in the UK. Doesn't have quite the same advantages as EMI. So, for example, it doesn't give that entrepreneurs relief, giving you a 10% tax rate on CGT, and the limits are a lot lower. So you can only grant £30,000 worth of options each time under CSOP, whereas with EMI you've got a limit of 250,000, which is obviously quite significant, especially for a startup company. It's not quite as flexible, so you can't use different classes of shares very easily for CSOP. With EMI, you could grant options over shares that didn't carry any votes, for example, which is helpful if you're worried about control of your company. But if EMI is not there and you've got the right share structure, CSOP is probably the next best option. And EMI and CSOP have to be used for employees, can usually only be used in the shares of a top company. So if you've got non-employees or you're looking at a subsidiary company, you can't use those tax advantage schemes. You'll have to use a non-tax advantaged option, which will mirror the effect of EMI CSOP, but all the gains will be subject to income tax and potentially national insurance contributions rather than CGT. It's not as tax efficient. And I've also noted phantom share options, but that's really, it's pretty much a cash-based bonus scheme based on a share price. Again, you're not going to get any tax efficiency there, but of course you do have a great amount of flexibility because there's no particular rules to follow, like with the EMI and the CSOP. There's no limit, so you do have a lot of flexibility with those plans. The next row is shares where you can buy, but you can allow employees to buy shares or non-employees to buy shares. So your deferred share purchase plan will let you effectively allow employees to pay to buy shares now, but leave the value of the shares today outstanding as a loan. So you kind of you defer the actual share purchase. It does have a few advantages, especially if you can't use EMI or something similar. As I said, you can use it for non-employees as well as employees. It allows payment for the shares to be made when the participants have the money. So you could potentially allow them to pay a loan off out of dividends that they get on the shares or from the proceeds of the sale. The employees or the participants become shareholders immediately, and that means they can benefit from shareholder rights like votes and dividends. And finally, the future gains are subject to capital gains tax rather than income tax, which is what would happen if you used an unapproved share option. So you're kind of moving straight into the capital gains tax regime, albeit you've got a loan outstanding on the value of the shares on the day you bought them. The big downside is that there is a financial risk. So if the value of the shares goes down, the participants are still on the hook for the amount they promised to pay at the outset. So it's not a scheme we would recommend for anybody other than very senior employees or consultants. I wouldn't recommend it for a sort of standard employee share scheme. An alternative approach is you can use gross shares, which is a slightly more complex arrangement. You'll usually need to change your articles effectively to create a new class of shares, which will only deliver value when the companies hit certain hurdles relating to value. So you make sure that the share value has to increase beyond a certain predefined limit, and only once that limit is achieved and the hurdles are reached do the shares actually hold any value. And the point of that is at the time the employees acquire the shares, they don't pay very little. They pay very little or nothing at all for the shares that they acquire, because at that point the shares aren't worth anything because they haven't reached the hurdle. They only start delivering value once that hurdle has been reached, usually on the sale of the business. And again, you're straight into the capital gains tax regime rather than an income tax regime. You can also use gross shares inside an EMI wrapper so that the participants can benefit from the business assets disposal relief. Downside of gross shares is that drafting the share rights can be complicated and expensive. And at the moment, HMRC are perfectly happy with these type of plans. There's no logical reason why they should be challenged. You are making sure that there's a valuation attached to the shares that is low because the shares do not have any value at the time they're acquired. But you never know what HMRC are going to do. So that's the only thing I would say about that plan. Works quite well for, we're seeing increasing numbers of private companies using them actually. So the third plan in this purchase box is the share incentive plan. And this straddles both purchase and gift because the SIP is actually the most tax advantaged share plan available in the UK. It's the only share plan with government blessing that allows people to buy shares. And ultimately, it's extremely tax efficient because you can effectively create a tax rate on SIP shares of 0, no income tax or national insurance when the shares are bought or gifted to them, and no capital gains tax when the shares are sold. Very, again, flexible plan. It allows employees to be gifted shares without them paying a penny in tax or national insurance at that time. It allows them to buy shares up to £1,800 worth of shares each year out of pre-tax salary. And for each share that they buy, an employee can be given a further 2 free shares, known as matching shares, without any tax arising. So effectively, employees can receive up to £9,000 worth of shares in their employing company, but only pay a tiny fraction of that amount because they're buying the partnership shares chunk out of pre-tax salary. Now, obviously, there's a pretty impressive tax break, so government wants you to jump through some fairly serious hoops before you can get that 0 tax rate. So the share incentive plan has to be made available to all of your employees on a broadly similar basis. And that's not for everybody. And the other point is that the full tax breaks are only available if shares have been held for the employees for a minimum of 5 years. The plan does require a separate trust to hold those shares on behalf of the employees. So it's long term and it's got a trust, and there are lots of ways you can offer shares under it, which makes it in one way flexible, in another way complicated. So it's not necessarily the cheapest plan in the world, and it's not one that's the most straightforward to administer. There's more work involved in a SIP than there is in an option plan. However, if you are looking to reward all of your employees and thinking a little bit down the John Lewis end of the market, SIP really can be an excellent solution for you. And then the final scheme in these blocks is the relatively new, not really that new anymore actually, the Employee Ownership Trust. It has been around since 2014 now. It's a trust that has a controlling interest in a company, more than 50% of the shares, which is held on behalf of all the employees. It doesn't involve individual share ownership, although you can run these other share schemes alongside it if you want to do that. The particular tax advantage for employees of an EOT is that a company that is controlled by an EOT can pay tax-free bonuses of up to £3,600 per annum to each employee. The other tax break related to EOTs is that a selling shareholder who transfers a controlling interest into an EOT will pay no capital gains tax on that transfer. So for retiring shareholders who want to keep the existing company running sustainably and for the long term and would like their employees to be involved in that, an EOT can be a really attractive alternative to more traditional trade sale approaches or voluntary liquidation. So this is all pretty theoretical. I thought I would just run through a couple of examples in the real world. So I'm looking at Nikki and Vicky with a startup. They've got a cracking new little restaurant chain. Well, it's probably not cracking at the moment, but let's see where post-COVID. They've got a great new restaurant chain and they're growing because they've got lots of outside space and they've got lots of patio heaters, so that's all good. They want to sell in 5 years and they want staff to work towards the goal of sale and reap the benefit. They've got a key FD, but they can't really afford to pay him what he wants, and they've got an NED who is happy to take hardly any payment as long as he gets equity because he thinks he's onto a good deal. So they want an exit plan, only reward people if the company's sold. They want to use options, not shares. They don't want to lose control. They've already given some up to some investors. They need to differentiate between their finance director and some of the other staff. They need to think about the NED. Can't give him a tax advantage scheme. They probably want to think about modelling to make sure they've got enough shares for new joiners in the future. And they need to take into account their investors' views. So with a business like this, it's an ideal scenario for EMI, really good for startups, early stage in the life cycle. So you've got a low share value, which means you can give more EMI options away for less money. You can include part-time employees, which is great for a restaurant because not everybody's going to be working a 45-hour week in a restaurant. You're going to have front of house staff who might just be doing evenings or whatever, but you can use those as long as they spend the majority of their working time with the company. You can give more to the finance director. You don't have to treat people equally under EMI. You can give everybody options under EMI, but you could give 1 share to your receptionist and 100 shares to your FD, whichever you want to do. Take a little bit of care about the valuation, because if you've got investors, you might need to consider the price that they've come in at. Very often it's easy with a startup company with no trading history to say to HMRC when you agree the valuation that actually this company is not making any money, it's not going to be making any money for a few years. Those investors' prices are just hope value. And that's the way you try and fix a low share price for your startup company at the outside. Your NED, he won't be able to get EMI because he's not an employee. You might want to consider your deferred share purchase plan arrangement for him. So for the little startup there, an EMI plan that will cover everybody, including the FD, different performance targets for the FD, and something a bit different for your non-exec director. Moving on to a slightly more mature business. So we've got a successful 20-year-old company, very profitable, nice, strong management team. Kevin's looking for a trade sale, 3 to 5 years, time to plan that. And he'd like to reward his managers now on an ongoing basis, but with an additional reward when he finally achieves that sale target. So he needs to identify who his key team members are. He wants them to get some kind of intermediate financial reward, extra bit on a sale, but only delivering an extra bit if you reach an exit with a certain value. So he's generous. He's not that generous. He doesn't want to give stuff away for nothing. So again, you can still use an EMI plan. EMI plans are available for companies, as I say, with up to 249 full-time equivalent employees. So it's not just little tiny startups. You can often use EMI in much larger companies, which is why we use it the whole time. You just need to bear in mind that you've got a £3 million maximum limit for all options and a 250k limit per employee in a company. So depending on how valuable the company is, there might be a limit on what Kevin can actually do with EMI. If he's wanting to reward employees now financially, but he's worried about control, because most private company owners are worried about loss of control, he could use non-voting shares for his management, but make sure that they pay a dividend, so they're going to get a reward based on profits between now and the sale anyway. And then he could have some additional options that would only become exercisable if the company sells beyond a certain sale value. Kevin's EMI option plan here is going to be a bit different from Nikki and Vicky's because it's not exit only. So he's going to be in a position where senior management team may well exercise options after 2 or 3 years or based on performance, at which point they become shareholders. And he will need to think quite carefully about what happens if those employee shareholders cease employment before the sale happens. So he needs to make sure he's got leaver provisions for shares set out in his articles, as well as the usual lapse provisions for an option for a leaver. And he might also need to look at his articles to make sure he's got drag and tag in there to make sure that there's no difficulty about employee shareholders preventing him selling the company when the time comes. Not very common for employees who are going to make money on a sale to prevent a sale happening, but there it is. Have them in just in case. He might want to think about some modelling and equity modelling and valuation to make sure that he's got a suitable level of award for employees on the sales. I mean, the usual thing is you work backwards. You're planning to sell the company for, say, 10 million or 20 million. How much do you want your senior employees to get on that sale? And then work back from that and work out what percentage of the company you want them to acquire in order to deliver that value. So you're working backwards with the number you're wanting to achieve, then the number you want them to get, and then the number of options that should deliver it based on your targets. And this is just good housekeeping anyway. Whatever type of share scheme you have, if you're looking for a sale, one of the first things that will happen is obviously the acquirer's lawyers will be all over your books and doing due diligence. So it's really important that you keep your scheme administered well and you keep your records really in order. So for example, if you're agreeing a valuation with HMRC, your EMI options, make sure you've got records of all those valuations agreed. Make sure you know who's left, when they've left, if their options lapsed. Did you buy the shares back? What did you pay for them? And just have everything in a really nice, neat bundle ready for the due diligence when it arrives on that sale, because it just makes life a lot easier when that sale situation arises. And then my last one, just a quick gallop through with a succession question. So again, this is something we get a lot. You get, so say for argument, we've got a firm of architects. Sort of it's a kind of partnership structure, but they're incorporated and the partners want to retire over time, but some of them might want to keep an interest in the business as it goes forward. They've certainly got no interest really in selling it to anybody else, and they want the business to carry on sustainably, really want to transfer it to their current employees, with some key managers perhaps getting a bigger share than some of the more junior staff. So we're going to think about how they want everybody to participate. Is it going to be key employees only? If they're going to be differentiating, where's your baseline? Are you going to give all employees X% with additional rewards for higher level people? How much do the existing owners want to hold on to? So another point, and how much do the people who want to sell to get for their shares? If you need to think about the time period for this transfer, it's like any other transaction. You're not going to hop into it overnight. You need to think about when people are going to be retiring in the future and the business's sustainability going forward. So it's quite a big, obviously succession is a big question, and I don't want to suggest for a second that the answer to all succession problems is a share scheme, because it isn't, but sometimes it can be, and sometimes a share scheme can help. So the first and most obvious answer to this particular case study is you transfer the owner shares to an employee ownership trust, which holds it on behalf of all of the employees. As long as a controlling interest is transferred, 50% plus, the sellers will not pay any capital gains tax, and then the company can pay those tax-free bonuses I mentioned earlier. Remember, you don't have to sell all of the shares to the EOT, just 51% will do it. So some of the existing partners or directors could retain an interest in the business going forward. If you've got an EOT, as long as the EOT doesn't lose that controlling interest, you can arrange for top-up options, EMIs, for example, for senior managers with flexible exercise provisions. If you've got more than 250 people, you might need to use a CSOP, but you can still use tax-efficient options alongside an employee ownership trust, as long as you don't break that controlling interest of the EOT. And similarly, if you wanted to have direct share ownership for all of your employees post an EOT transaction. Again, you might want to consider using that share incentive plan we talked about earlier with your partnership shares, where employees can buy shares and then receive matching shares and or free shares alongside. So it's perfectly possible, if you've got your company owned majority by an employee ownership trust, you can run those tax efficient share schemes alongside it to give employees the benefit of direct ownership in the future, including dividends and votes as required. And sometimes that's quite a nice mix, because the EOT effectively just sits there holding a majority interest of shares, doesn't really do anything. You've got your EOT bonuses that you can pay each year, but you haven't got any direct share ownership. So some companies want something a little bit extra to keep their employees motivated and driven post the EOT transaction. So that's a few thoughts about how you might manage succession in a private company using an employee share scheme. That is, I think it's midday, dead on, so I've just got into my half hour. I think it's quite helpful to have a kind of there's 3 things you take away. Always look at why first. Don't go in going, I definitely want an EMI or an SAYE or a SIP, whatever. Always think first about why you're wanting to do this and what you're going to achieve. Do try and keep it as simple as you can. There are 2 reasons for keeping it simple. 1, simple is cheaper, and 2, simple is much easier for employees to understand. If you've got a really complicated share scheme that even you're struggling to get around your head around, your employees will probably struggle to get their heads around it as well, and that means it stops being motivating. And that is really one of the main points why you want a share scheme in the first place, to motivate your employees. So you don't want them confused. It's sometimes difficult enough to get your head around what an option is and what a share is without adding in complexities like growth shares and performance targets and so on and so forth. Try and keep it as simple as you can. It does work better. And then last of all, don't let the tax tail wag the commercial dog. So, for example, I know a SIP is an absolutely brilliant plan because it can give 0 tax rates, but you need to think very carefully about putting in a SIP, because you have got all those all employee, the fact that the plan has to be offered to all employees, and it is really a minimum 5-year plan. It's a bit of a SIP is for life, not just for Christmas arrangement. So it's a great plan if you want it to do the things that it does, which is deliver shares to employees. But if you're going to go in for it just for the 0 tax rate, it's probably not going to work, and you will just end up paying a lot of money for something that's really not working for you the way you want it to. So so those are my 3 takeaway things. That is technically the end of the webinar. I believe there is a way for you to send questions privately on the webinar if you would like to do that. Alternatively, as I say, you can just contact me, and I am more than happy to talk to anybody about share schemes, pretty much for as long as you like. Can't see any questions coming up immediately, so either that means I've told you everything you need to know, or it means I've left you so confused you don't know what to ask. I hope it's the oh, here's a question. With grey shares, what is the current HMRC view on valuation? We usually just do valuations for EMI over growth shares, and at the moment we are finding that, well, I mean, with their growth shares, obviously you need to be looking at forecasts. So actually you generally need to be telling HMRC not just about past trading, but also with the forecast, because if you've got a hurdle of, say, you know, £5 million for the company selling at £5 million, no point looking at it necessarily. You need to look at it today and then work out how likely you think that the company is going to achieve that forecast in the future. So there's no particular change to HMRC's views on valuation of growth shares as far as I'm aware. Different people have different views on that. We're just using forecasts and an argument of what the shares are worth like today and a likelihood of that hurdle ever being achieved based on the company's current performance and forecasts. Oh, I hate these things, they're so tiny. Please could the slides be sent via email? Yes, if you send me your email address, I will be happy to send them to you. That'll be fine. There is a question here I just saw. Shares, what was the current interest? If a SIP is used, is a trust tax return required to be submitted to HMRC? Yes, I believe it is at the moment, but if the SIP is active and there are CT relief on EOTs, I don't know the answer to that immediately. I don't see why not, because it's probably corporation tax relief in the same sort of standard principles for corporation tax relief, but I don't know if there's a specific corporation tax relief for EOTs. I would have to look that up. Do CSOPs have disqualifying events such as EMIs? Well, yes, they do, but it's not quite the same as EMI because you haven't got quite the same rules. So, for example, you don't necessarily have the trading activities and, for example, acquisition of non-qualifying subsidiaries and so on. There are some disqualifying events, and I can't remember what they are off the top of my head at the moment. There's not anywhere near as dangerous as the EMI disqualifying events. Is there specific tax avoidance around EOT? For example, using it as a stepping stone to a third-party sale. I don't think there is specific anti-avoidance, but the point, obviously, I would not use an EOT as a stepping stone to a third-party sale. Yeah, there's no specific anti-tax avoidance, but you normally get a tax clearance with HMRC before you put in the EOT, and yeah, clearly they can come back on you if you're using it as a way of getting through to a third-party sale. The main principle behind an EOT is obviously you're supposed to be transferring to employees in terms of creating a sustainable business for the long term for employees to own the company. So if you're going to transfer to an EOT and then sell on in a very short period of time, then I think there could well be problems there. I can't see any other questions. I'm sorry to sound a bit gibbery here, but no CG at all when EOT, when owners sell their shares to their employees. It's not selling to employees as such, either part or full sale, as long as the trust retains 50%. Yes. If you sell a controlling interest to an EOT, there is no capital gains tax to pay. Is the answer to that question. With all of these questions, some of them are probably a little more detailed than we can cover on this webinar. But if you want to send us questions, we can point you in the right direction. And I think that's all the questions there are that have been submitted there. As I say, the easiest way to get in touch with me is drop me an email, ask me the question, and I will. Just wondering, hold on, I'll find another one. Just wondering if you genuinely set up an EOT, but then a third-party buyer comes along later, assume this means the trust sells the shares and would require buying from all the employees. Well, yes, I mean, yeah, it would be fine. I mean, an EOT controlled company is just a company with a majority shareholder that acts on behalf of all the employees. And the trustees would probably, you would probably have to get buy-in. You wouldn't necessarily have to get all employees to necessarily sign something, because the EOT itself would be the shareholder, but the trustees would need, at the point of that third-party sale, to take into consideration whether or not that sale was in the best interests of the beneficiaries. And it is very likely that you would need to discuss that amongst the employees. The trustees' job would be to do that. But I mean, there's absolutely no reason why. I know this sounds like I'm slightly contradicting my question. There's absolutely no reason why an EOT controlled company can't then undertake a third-party sale at some point in the future, because things happen to companies and things happen in business, and you deal with them as they come along. It's just a question of obviously planning that is not really acceptable. And what was this fun? Not a question, but thank you for the webinar. Oh, thank you. That's very sweet of you. Oh, who pays the bonus to the employees within the OT? The company does, not the EOT. The company pays the bonus to the employees within the OT. The EOT doesn't have anything. It's just a trust holding the shares. Lots of questions, but I think that I've tried to answer them fleetingly. As I say, drop me a line, and I would be really happy to try and help you with others if you would like me to do that. So I think I will wind up now. Thank you all very much for listening. I think there is a follow-up survey coming from SurveyMonkey, so do please feel free to fill it in, and then we can improve things if they need improving. I hope you've enjoyed the webinar. We do run various others, so keep an eye on our mailing list, and it'd be good to see you at other webinars that we hold. So have a good morning, everybody, and I will see you again one day. Bye.